America the Great. All right. Hey, trust you're doing well. We're talking inflation, jobs, impact. What does that all mean? Each week we seek to share with you some impactful insights of what we're either working on or what we're seeing in the macro economy. So we just saw, of course, this week inflation came in down 0.1%, down at 3% for CPI, and lower than expected. And so that's a good sign for the Fed. It's a good sign for the economy. But even more so, we saw the bond market previously last week was responding also to the jobs numbers coming in with higher unemployment ticking up to 4.1. So you've got a couple of things going on right now. Inflation was coming down. Part of the drivers there that are helping to impact that are cheaper gasoline prices, and then also lower cost on housing. There's just less of a surge right now in the cost of housing. Nationally, again, you got to look at each housing market on a market basis. But so looking at those things, what does that mean? So Powell already made comments with respect to the concerns with respect to the cooling of the labor market. And if you look at the underlying issues of the labor market, you go back to April, they reported 168,000 jobs, and then they last week revised those job numbers down to like 101,000 or 110,000. So it's like, oh, you know what? It was 168. No, by the way, no, it wasn't. We clip off 60,000 of those jobs. It wasn't really what it was. So, the labor market's cooling more so than what's probably what I would say is being reported. The drivers that continue to be there are, government, healthcare, and leisure. So it's like, tough categories. Those are not really economic drivers. You know what I mean? Those are not companies adding tons of new people. That's the government filling out positions. It's healthcare adding positions, and it's leisure still filling back from, the shortages from the pandemic. But all of this is good news. All of this is, and again, that's kind of a weird statement, right? It's good news that things are cooling. It's good news that inflation is cooling. Interest rates start to come back down. We did a video before and talked about the neutral rate, that rates, though they are on the track, on the horizon to come down, it's not something that we should just immediately expect it's going to be, oh, this is going to be an incredible thing. People also expecting that, rates are going to go back to where they were before, probably an unrealistic expectation. I was just talking with a friend of mine, ex-hedge fund guy, and, we talk and consult every week, and he shared with me one of his friends' analyst chart that tracks the bond market here in the U.S., and he's a technical analyst, and based off his charting, he was showing that the, 10-year Treasury could come down to the 3.5 to 2.5 range over the next 12 to 18 months. Now, again, that's, a technical analysis. It doesn't take everything into bear, but it's a data point. And so even with these, what we would call, good news elements, and the, Wall Street and professional money, we've talked about that before, they're getting ramped up to be like, yeah, rate cut in September. And that may happen. There continue to be enough data. Powell will talk about it in the meeting later this month in July, kind of signaling what he's thinking. There is a concern on his part about the labor market. They don't want the labor market just to fall off and then now, move more aggressively towards recession. But what does that mean for you and I, right? So we're cautiously optimistic. So again, there are opportunities that are going to be there. I've seen people, and we'll do a video on this, deal of a lifetime, like that they're proposing and thinking and basically betting on, interest rates are going to go down. That's what makes this a great deal. And yes, as interest rates go down, that does improve the valuation because that is a significant factor in valuing the, future cash flows. And so you have to look at these things. And what I would say is like, yes, data's coming in. There's going to be more data coming in. We don't want to jump at that with over enthusiastic optimism, right? There are some people that, again, they felt beat down for so long, they're just going to boom, jump. And that's not the way to go. You have to be patient. And, even too, we've talked about this. We have not bought a new deal in the last 2 years because none of them met the criterion of our stringency of what qualifies for a great deal for us and for our investors. And so I want to encourage you that there's going to be a bandwagon. A bandwagon will jump on the train of like, wow, hey man, rates are going down. This is this, this is this, this is this, now. And it's like, let's be a bit more patient. Rates will come down. It's going to still take more time. And then the other component, what I would say this is, we're looking ahead over the next 5 years. What we're doing doesn't just mean impact for the next 12 to 18 months. What we're doing is looking out over the next 5 years or 10 years. And I would venture to say that we're going to have a more volatile interest rate environment and or volatile overall economic environment over the next 10 years, or at least the next 5 years. And so again, I think it's important to be prudent, to understand what these things mean, and then to be able to act with that accordance. Yes, we're going to have some great opportunities. There's no doubt about that. Yet I think prudence is still going to be the necessary rule of thumb. So praise the Lord. Hey, thank you so much. Have a blessed and victorious week, for this is the week God has ordained for you.